We are live.
Live? Okay. So we can start, Arindam, Jabir?
Yeah, go ahead.
Yeah.
So, good evening, everyone, and welcome to our webinar or another webinar of Marcellus Global Compounders Portfolio. So, as you can see in the slide, we complete 1 year of Global Compounders, and with me, I have the fund managers of this product, which is Arindam Mandal and Jabir Sethi. As you all know, just wanted to reiterate that the Global Compounders Portfolio is registered in GIFT City and regulated by IFSCA. So, over to you, Jabir. We would like to hear from you how this 1 year has been and take it forward. Thank you.
So I am not the right person to describe how the year has been. That person is Arindam. But because I'm the other part of the conversation, I will be the one asking the questions. So, Arindam, when we step back and think of 2022 from the outside was like a scary year. So much macro uncertainty in the West, a war in Europe, so many things happening. So can you describe the context of how GCP came to be and the journey of what was happening in the world when you decided to launch?
Sure, Jabir. As you rightly said, I mean, there are a lot of things going on across the globe. But let's just dial back a little bit further. I mean, little back. When you first met and we talked about the product. So there are two things that definitely came into our mind that this product has viability in two senses. Number one, of course, from the investment standpoint, US has always been a great market to invest. It's one of the best markets to invest. In fact, the best. If you look at 10, 30 year, any time frame, longer time frame. That is number one. So for Indian investors, it actually makes a solid case that you can actually diversify your portfolio, number one. Number two, many Indians, they are actually unknowingly to some extent, they're kind of building a liability in the US dollar terms. If you think about probably, many of us would like to send their kids abroad. So in that case, you are actually, there's a future liability built in the USD. But if you are keeping all your assets in INR, then there is a mismatch. So it should be taken care of. So that was the context that why this product was needed. And coming to the philosophy, Jabir, we wanted to keep it very simple. If you recollect that we want to invest in, we find out 25, 30 stocks and make sure that we take advantage of market dislocations and eventually build positions in some of these stocks. Now, coming back to 2022, how the year looked like, especially when you were sitting down sometime in September, October. As you can see in the chart, the CPI, the inflation numbers are actually through the roof. We have not seen inflation like that in last 20, 25 years. I mean, you can see in the chart 8-9%, never kind of unheard of, at least in our generation. Partly driven by the spike in oil price. $80 oil price is not something that we have not seen. In fact, oil price used to be around 100 plus till 2014-15, before the shale evolution happened in US. But still, it went up from a very low base. And of course, the supply chain constraint that was taking place. So that drove down a lot of challenges across the global supply chains, as you can see in the CPI numbers. Now, that was kind of the backdrop. And to take care of that CPI, that high inflation, the most potent tool any central bank has is basically you can just take up the rates. So that drove the Fed funds rate to quite an extent. I mean, even since then, the rates have gone up. But by the time we launched it, actually, that time it was hovering around 4%, 4-5%. Again, that rate, something similar to what happened in early 2000. As happens with any time, actually, in every year you find people who cause doomsday. Every year something happens. There are a lot of economists, there are a lot of headlines that how S&P can go further down 40%, etc., etc. But in a nutshell, Jabir, if you think about the philosophy we thought about, we really never wanted to time the market. We know that we cannot. So even though the backdrop was not very ideal from macro standpoint, but still we thought about going ahead with it.
Given this backdrop, it's one thing to have a philosophy which says that yes, we ignore the market. It's quite another thing to actually put money to work in a time like that. So where did the confidence actually come from?
Well, I mean, that is one of the nicest thing about Marcellus, that every fund manager has to invest their own money. So basically, if you can recall, I was the first investor, you were the second. Now, what gave us confidence is this table. If you look at this is the table that we looked into when before starting the fund, because it's 2021 data. That's what we had available back then. Now, when I'm looking at the table, this is basically the fundamental performance of the companies that we are planning to invest in. This is a short list of companies that we did after research. If you look through that entire time frame in any rolling 5-year window, just look at the EPS and free cash flow CAGR, 16 to 19%, very steady. Similarly, if you look at what S&P did, a little bit more volatile. Now, our point was that, Javier, at that point of time, we don't know what the market is going to do next year. But if I'm taking a 5-year view and I'm investing in these companies, their fundamentals would at least compound at around that same 16%, for example, to be conservative here. If that is the compounding that we're going to get, even if the market say draws down, say 15, 20%, it is actually an opportunity for us to get some of these things cheaper. So I would say that when we looked into this table repeatedly again and again, that built us confidence that we are actually investing in companies which have proven history, which have compounded at a steady pace across the cycle, and at the same time, you are getting them actually in a very reasonable valuation, in a relative sense, both in relative sense as well as the DCF kind of long-term cash flow compounder kind of valuation frameworks that we have. In both sense, it made sense to us that, okay, I'm not looking for next 1 year. In fact, if I can recollect correctly, you are much more positive about the market back then than I was. But irrespective of that, what we both probably believed that these companies are going to work for next 5 years, and that was the conviction that we had.
Yeah, and that conviction was indeed, I think, what both of us had. But how has the last 1 year actually been? Because if I think about the 12 months before that, there was a whole lot of things that happened in the world. In the last 12 months, there's a whole lot of different things that happened in the world. So how's the year actually been?
Yeah, so broad standpoint, if you look at take a very top level view, there are two things that I think stood out. I mean, there are a lot of events, global events that happened also, but two things that stood out to us. Number one was definitely AI. That was a clear game changer to some extent, and it gave a lot of impetus to some of the largest stocks that S&P 500 has. We have put a chart here on the headlines that came through since, say, November, December last year. So Chat GPT, then the Bard AI that Google launched, followed by Adobe. Basically, every large company, they came up with their own AI engine or some kind of AI agents, etc. And as a result, what happened is the entire ecosystem of the tech side, especially on the semiconductor side, NVIDIA was the cleanest way to play this entire thing. Those stocks actually quadrupled. I think NVIDIA went from somewhere 200 to it is probably at 450 or something. It had a dip in between. But again, the point is they had massive rally. That was number one on the tech side. And then secondly, another thing happened is the crash of Silicon Valley Bank. That happened in March. Now, that was actually, I would say, a kind of very negative event for the broad economy in that sense, because that's the first time we actually understood some of the impact that kind of whether interest rate is going up, what kind of impact a bank can have. We got the first glimpse into it because Silicon Valley Bank was actually quite loved by people, loved by investors. But that bank imploded in March. So this is the chart of the regional bank index, their stock performance. So you can clearly see that the regional banks broke down with the fear that there will be a lot of delinquencies, etc., that would happen. A lot of banks, a lot of them would go bankrupt, which happened actually. Many small banks went bankrupt. But interestingly, the economy held up pretty well. I mean, all the large banks in US, they are actually well capitalized. If you look at JP Morgan, Citi, I mean, all the large banks are well capitalized. So the the kind of problem that the smaller banks faced, the larger banks did not, and they control most of the assets. Now, what it did is it changed the market sentiment significantly. Now, if we look at it, this is actually an interesting chart. So if you look at the stock performance, like if the red line is the S&P 500 index, while the big 7 or 8 stocks, they control around 25% or more than 25% of the total weight of the exposure. The gray line is the equal weighted. So you take all the 500 stocks you have in S&P 500 and equally weight them. Now, you can clearly see a dislocation towards the end of March. They got disconnected. So most of the investors, they're kind of looking for solace, like what is the best place to hide at this point of time. And as a result, you can see the bifurcation that happened after March. So on the large stocks, like the S&P 500 index, which had heavy weight on the larger stocks, they tended to outperform, while the S&P equal weighted index, they actually did nothing. Typically, this is a tough time for any active manager when your entire market is driven by select few stocks. In fact, I was just pulling out some data yesterday, and it came to our notice that not yesterday, actually last week, it came to our notice that only 28% of stocks within the S&P 500 index, they have actually done better than the overall index. So that was the kind of concentration that remained within the index. Now, interestingly, as you can imagine, I was saying that almost 2/3 of the active managers, they have not been able to beat the market. So the Jefferies data they publish every month, and you can see that the mid cap core in the US or the large cap core, most of them have been underperforming for the thing that I just explained. But GCP somehow, I'm not say somehow, but interestingly, it was able to outperform significantly despite not having any big exposure towards this big 7 stocks. When I say big 7, basically you're talking about Microsoft, Apple, Google, Amazon, Tesla, Nvidia. I'm missing something. Yeah,
Meta.
Facebook, right? Meta, right? This is 7 stocks. So we didn't have any position in Meta, Google, Tesla. We support on Nvidia, right? We didn't have any exposure to any of those, but still we managed to hold up our fort quite well. In fact, the stock selection, I would say, Javier, as head of research, actually did a great job in selecting the right stocks. So yeah, that's how the year looked like. It started off in a different note. It ended in a different note. We'll see how it happens. But as I said,
so this sort of outperformance that you saw over the past year, what drove it? Yeah, if it wasn't the big 7, because big 7 was the shortcut. If you owned a lot of the big 7, you automatically did well.
Right.
How did you manage without owning those?
Right. So broadly, Javier, it was based on EPS growth. Now, we do not look into the trailing 12 months EPS. So because trailing 12 months is basically your history. What we do is we look at, so for example, the exercise we did here, what was the EPS estimate for next year? So for example, if you are in October 2022, what is the analyst estimate for their earnings or say cash flow per share, depending on which company you're looking at, for next year, say next in 2023, what was the number? Now roll forward 1 year. What is that number for 2024? And basically the gap, the increment that you get there, that tells you how the earnings estimate has moved. And that primarily drives your stock performance broadly in an aggregate basis. That's how it works. So if you look at our portfolio, I mean, we have listed down some of our best performers here. on an average, our portfolio, the EPS numbers have moved by around 12%. And the S&P's EPS number have moved around 4 to 5%, somewhere between that. Now, remember, when you're, it is not just you are not equally weighting the portfolio. What you're doing is a portfolio construction process where we try to weigh the stocks differently. So because of that, weighing the stocks differently, that added around a couple of points above the average EPS growth. So you can see like the average EPS growth was around 11.9%, but after that, the portfolio construction, because of that, it was 14.1. So if you think about it, we outperformed by around 10%, and that is primarily driven by the earnings growth. So our companies had the earnings growth, the revision for 14%, on an average S&P got 4.5. So that 10% gap, that's what primarily we delivered as an outperformance.
And in this outperformance, was there also an element of valuation re-rating? But at least based on this, it looks like it was all earnings. But did valuation also play a role?
It did not. Well, I have to answer it in two ways. When you're looking at a company, relative valuation also plays a part into it. The reason we use relative valuation is the fact that we cannot. It is very hard to estimate the right P for S&P 500 or any index. But that is a very good proxy in an index level. What is the cost of equity, or what's the cost of capital for an equity investor that bakes into it? Now, once that problem is resolved, you can actually benchmark the multiple on that, say S&P 500's EV/EBITDA. That's what we did. So you take the S&P 500's EV/EBITDA, you take the company's EV/EBITDA, and then what you do is you find the relative valuation relative multiple what it is trading at, and do the same thing next year and see what is the average valuation at the portfolio level. Now, interestingly, if you look at that, the relative valuation hasn't moved a bit in last year. In fact, we have data since 2019. From 2019 onwards, the relative valuation has been actually quite stable at around that 1.6 times. The point being that you just mentioned, so the entirety of the outperformance has been driven by earnings.
And in this, you pointed to that extra performance which came from portfolio construction or from allocation decisions. So we can see that they contribute, but what drives that?
Right. So if you think about it, there are a lot of inefficiencies in market at times. If you recollect how we did that tool, the torque tool that we use. Let me get you that. Yeah. So the torque tool that we use, the torque tool basically tries to look into the time when a certain group of stocks are significantly overvalued to their history, and a significant number of stocks which are undervalued relative to their history, and they need to converge because we're anyway looking into a quality index, and the torque tool just does just that. Just to give an example, if in the right, the top right, the right chart that you can see here, we did a hypothetical simulation. For example, so that if you can recollect, we divide our regime into three broad buckets. The stock can be either defensive, the stock can be either cyclical, or it can be either some kind of growth. Okay, so defensive is basically the stocks like Berkshire, the armies of the world, where the economy doesn't impact their intrinsic value growth that much. Of course, it does, but not like many other companies. That is your defensive. Then the cyclical group is basically your ASML kind of stocks, or the industrial stocks, where you see a lot of cyclicality in their earnings profile, but through a cycle, many of them actually produce a fairly good result, like 13 to 15% of earnings compounding. Then the last group is growth. So growth is, for our companies, it is all profitable growth, but at the same time, growth tends to be very highly valued at times. Now, there has to be some kind of convergence mechanism like if something is running too far ahead of themselves, the mechanism helps us to kind of make sure that we take some of the inefficiencies that is baked into the market. So our framework suggested us to be defensive since 2021 November, the autumn of 2021. So what we did here is that, let us assume the dotted portion is basically before our live portfolio launched. So on a defensive mode, launch the portfolio with the weights, and it is still defensively positioned by our portfolio based on our framework. And you can look at it. So the drawdowns are actually not that significant. So on the left side of the chart, you can see that in the down market, this tends to hold up a little better. But in the up market, the portfolio tends to outperform by quite a lot. So that is why you're actually capturing the alpha. You're protecting the downside on a relative basis, but at the same time, you are trying to capture most of the alpha. So think about it. I mean, you can always argue that the market is pricey or it is cheap. I mean, it's a very kind of argument that comes up all the time, but none of us actually know the answers. But the fact is that even if we invested, say, at the beginning of 2022, when the market came down by 15, 20% or 25%, but you still would have made money investing in this portfolio over the next 2 years, despite the correction it had. The point you're trying to make is that, the portfolio construction basically makes your path to wealth creation a little bit more predictable. It cuts down the volatility. It adds to the kind of the return to some extent. So your risk-adjusted return is actually enhanced by quite a bit.
This chart that you have on the left seems to be illustrating that
Yeah.
In a down market, you do a little bit better, and in an up market, the gap widens.
That is right. Yeah. Right.
Is that?
Yeah.
Now, one of the questions which comes up a lot is around investing in the US at all, and it comes from the perspective that India is a high growth market. There's a lot of opportunity, and in that context, what makes US investing actually interesting?
Yes, you are right. Actually, I can answer you the question. Just let me take out and the slide take. That'll be easier. Just give me a second. Broadly, look, I mean, the points that you are trying to address here is that US as a market has a long history. So you can easily find data for US markets for last 100 years, actually close to 100 years, from 1929, probably we have the data. And from 1965, we actually have very high quality data in that sense. And what I have seen is that over time, over any 15, 20 periods of years of time frame, if you take that, you typically get a 9 to 10% CAGR. That's how the market operates. It has gone through many cycles for sure, but at all the point of time, at any point of time, I mean, you can see that there has been, of course, ups and downs. We cannot really escape that for any equity market, but over a longer period of time, you get a fairly good risk-adjusted return. Now, vis-a-vis, I'm still trying to find out the presentation, but I will tell you something that people get excited about growth of certain countries. For example, people talk about the growth of China. We'll talk about the booming 70s of Japan, 70s and 80s. Now, of course, they had a very good run for that 15, 20 years, but none of them could sustain. None of them could sustain that, in terms of stock market return. Only one market through the long period of time has been able to sustain that kind of return. Again, despite being a matured economy, despite being the kind of relatively lower population growth, US has they have been able to sustain that 9 to 10% of dollar return over time. Think about it, even a country like India, which has a very low base to start with, their dollar return compounding is actually similar or a little worse than US in last 30 years. despite we actually in 1992 when we opened up the economy, when you start from then, the equity market returns are not at all different. We have seen massive growth. Same goes for China from 1990 to say now. Their GDP growth has compounded at a rate of 13% CAGR per year for last 30 years. But their equity market return has been like 5 to 6%. Now that is the difference. So why that happens, there are a lot of reasons behind that. In my view, it's a function of them having very good institutionalized system. They have their miles ahead in terms of R&D innovation. They are miles ahead in terms of attracting the best set of talents across the world. In fact, I was going through some statistics. 57% of inventor immigrants, that's what they call it. So basically, who have invented something, who has some patents on it, they actually come from US. What that means is that people have migrated there in different countries, and people have filed patents. Out of those 57% of the guys or the ladies, I mean the people who got some patent, 57% of them are from the US, which is huge. So basically, you are getting the best talent pool, half of the best talent pool across the globe. You have your own talent pool. Out of the 15 top universities in the world, you have 11 of them just in US. So you are not starved for the most important asset in the world, which is human capital. So you are getting the best talent, you have the resource. I mean, if you think about the entire VC ecosystem, almost 50% of the entire VC money in the world that goes into US. So you have the talent, you have the money, basically labor and capital. You are investing in R&D, which is basically productivity. These are the three things that you typically need to function as a well free market economy. And it is very hard to match US in that front. One thing that comes up pretty often is something like the de-dollarization would happen and some other currency would take over, etc. But to be fair, I think it is way off. Just remember one thing: if you have to be a reserve currency, the country cannot have capital control. And if you think about the next biggest competitor of US, which is China, they have a capital control in place. So you cannot really run a kind of huge deficit and have a foreign, like have a reserve currency. That is not possible. You can argue that cryptocurrencies are a solution, but I do not think I have the visibility to tell that any central bank or any actually government would allow that to happen. So what that leaves us basically in a status quo. And if you're in a status quo, then there is no reason to move dollars from their current reserve currency status. Now, will you see more and more trading taking place outside of dollar? Probably possible. But if you think about dollar losing their reserve currency status, I think it is far off. It will probably take decades to happen. So putting it together, you have a reserve currency status, you have this plethora of talent, the best of talents coming to you, you have this availability of capital, and you have the institutions in place. So I mean that's a perfect recipe for free market economy, and it finds its way out to of any kind of negative impact that the economy or anything actually can have.
That was a detailed answer, and I think it reflects the conviction you've built having lived there for so many years. And there was have a shorter, simpler version of it. In every other economy in the world, roughly market returns tend to be nominal GDP growth. In the US, over any rolling period of time, they tend to be 2x of nominal GDP growth.
Yeah.
You can probably write a book about the why, but the what is straightforward and established well through history. We don't really expect it to change.
Yeah.
Now, circling back to the earlier part of the discussion that 2022 was an uncertain year. 23 itself has been fairly lot of interesting things happening. How are you thinking of the year ahead?
It is very hard to answer. Year ahead, in terms of macro, of course, we do not know. From macro standpoint, again, we are not macro expert by any means, But the positive is basically your CPIs have come down quite a bit. So we're into that 2 to 3% kind of range. We're getting into that range, which is reasonably good, the economic function. But at the same time, that is a positive. Then the negative is a lot of leading economic indicators. In fact, National Conference Board, they come up with LEI, which calculated from many sub-indexes. So that is showing a negative trend since last 12 to 18 months. So again, like always, there are some green shoots and there are some red flags. In terms of valuation, if I think about it, one easy way to think about it is where the market is now. Now the market is at around 18 times. What I try to do here is that at current level, at current market P level, how much the market compounded at for next 10 years. So if you think about 1996, if that is your starting point, and 2006 is your end point, because 1996, because that is the time that the market was trading at similar level, 1890, somewhere like that. You still got 8.5%. Similarly, in say 2017 to now, the market has not re-rated that much. We still got 11%. The point being that typically the 9 to 10% range that we talk about, that is something probably if you're looking at a 10-year horizon is quite possible. The 16 to 19 times P, that is the range of S&P. That's a good range to invest in, and we're there actually. If you're patient enough, it's a good time to deploy. Now, leaving aside all these things, and as I said, we ideally do not know what the market is going to do next year or so. When I look at these numbers, that gives me confidence. Even in this year, when the earnings growth was actually not that great, but still, if you look at the 5-year performance and the 23 numbers are basically estimate EPS numbers, our companies are still compounding at 17%, vis-a-vis the market at 7, the 5-year growth. Now, and that is exactly when we started the presentation we talked about, right? That we are looking for companies that can, through a 5-year cycle, they can compound at around mid-teens. And as long as they're doing it, I'm not that concerned about what the market will do. Any time is actually a good time to put in money. Unless the market is at abnormal levels, which we are not at actually. If you look at 2000, the chart that we are kind of showing there, the .com was actually that time. The market is trading at 28, 25, 28 times. We're not there by any means. So again, my view is that just invest in the good companies, make sure that you're not paying too much for them, both on relative basis. At least one of those is important. And as long as you keep on doing that, there is a good chance that you do much better than the market in next 5 to 7 years. So again, that is what is, I think, getting reflected. If you look at our performance even, right, that is what is reflecting here. Just buy companies which can have a reasonable valuation and compounding at a higher rate.
Yeah, I can get in touch. Thanks for that, Arindam. Ria, over to you.
Thank you so much. Thank you, Arindam. Thank you, Javier. So thank you everyone for attending the webinar. One important announcement which I would like to make here is, as of now, in all our webinars, we have been talking about the two structures in which the global portfolio, the global compounders portfolio is available. One is the fund structure, the K fund structure, and one is the PMS structure, which is via Gift City, with both has a minimum ticket size of $150,000. Now, Marcellus, we have been able to have a new thing in place. So today we are tied up with Crystal AI platform, and this offers the same global compounders portfolio, the US compounders portfolio, which Arindam manages along with Jaybir and the team, offers a minimum ticket size of $25,000. So this is kind of an advisory product in which the same portfolio is offered to the client. The client holds these stocks, but the minimum investment amount will be $25,000. Both resident individual clients and NRI clients can invest into this. The taxation of the product is exactly the same as the PMS, that is The tax is as per the country residence, whichever the country, whether it is resident individual or it is NRI, as per that particular country, the taxation will be applicable. No further changes in terms of the taxation aspect. Anybody and everybody who are interested in investing into this portfolio with a small ticket size, please reach out to us. We are available in invest@marcellus.in, or you can also write your email IDs or phone numbers in this chat box and we shall reach out to you separately. Any questions if you have as of now related to this product or the structures which is available, you can post. We'll address all your questions. Apart from that, later on, if you want us to connect, please let us know. We will connect with you separately as well. So thank you. Thank you for joining. We'll open the floor for questions. Pooja? Sure, Mr. Tushar, we shall connect with you. Thank you for your number. Sure, Mr. Bhushan, we will connect with you. Thank you. Arindam, one question for you. The market has moved up significantly in the last 2-3 weeks. Would you still recommend investing at current rate?
Yeah. So again, the timing the market is very different. But what I'll say is that consistently you should keep on deploying money instead of it is very hard to time the top or the bottom. But if you can do it consistently every month or say every quarter, then you will win in few cases in short term, but it evens out in the longer term. So no straightforward answer to your question, to be honest. But as an investor, I always prefer to invest continuously in portfolios. So I would say yes. But just be mindful of the ticket size that you are investing in terms of your net worth. That is important.
Sure. Thank you, Arindam. Thank you. We have another question. USD 10-year yields have reduced to 4.15% now. What would be the impact of that on equity returns for 2024?
I'll pick that one up. So the US saw through 2022 a very large cost of capital reset. Through 2023, some of that cost of capital reset has started to reverse. Right now, I think expectations are of 2 rate cuts next year. So some of this, and that's what's reflecting in the 10-year. Some of this has already started reflecting in things like regional banks or SaaS companies, which are very sensitive to the cost of capital. Given that the market seems to be reacting ahead of time rather than waiting for actual rate cuts and things like that, wouldn't necessarily expect that even on the way down, the market reacted ahead of time. On the way up, market would react ahead of time. So more than what happens in 2024 on rates, it's more what market expectations for 2025 shape up to be, which would impact the market, if at all. But these, honestly, these things are something we don't have the ability to call. So we don't factor them into trying to select stocks. The reason we look at the long term is because we're not confident of our capabilities to predict macro variables and things like that. Earnings is where we're comfortable. Earnings is what we focus on.
In continuation to that, there is one more question. What is your estimate as to where will the Fed rate stabilize and by what time, 2024 or 25?
We're not economic forecasters. The 2 rate cuts for next year are market expectations. I honestly don't have a firm view on what happens beyond that. The people who do that for a living, I've done that for a living for some time in my life, but I don't really have any confidence in my ability to predict rates 2 years out.
Sure. Okay. So one gentleman is asking how blended products like MF investing in Indian equity and global versus pure global from tax efficiency, we are investing in India in any way. Hence, blending in single product will add to tax efficiency. So in terms of taxation, sir, I mean, this product is in terms of diversification, that is US and India, domestic, of course. In terms of tax efficiency, for all resident individual clients, it's the taxation is as per unlisted equity. So 2 years and above, it's a long-term capital gain at the rate of 20% with indexation benefit. So Arindam and Jabir, if I understand this question right, in terms of tax, this product is not something which is like, someone should invest taking taxation into consideration, right?
That's right. See, it's not a tax saving product. Generally, taxation is lower on domestic equity instruments than on this. So yeah, the bigger benefit comes in terms of one, diversification. Second, that diversification is not just in terms of currency and assets; it's also in terms of uncorrelated volatility. If just taking a hypothetical example, if the market in India reacts a certain way to, say, elections next year, that won't really show up in what the US market is doing. Conversely, if the US market reacts a certain way because of the elections there a year out, that won't really show up in Indian market returns. So that diversification, that lack of correlation is the other benefit.
Sure. Thank you. One question. Anindam, you were saying something?
Instead of doing a fund structure in India, PMS is a better way to do it, right?
Correct. That is for the global compounders portfolio. Yes, it is tax efficient. But if I, as Jabir answered, in terms of tax efficiency, if someone is looking for, no, it is more to do with the product itself, as in terms of diversification and adding value to one's portfolio.
Right.
One question is, do you see continuous growth for ASML in long term? Do you see any considerable threats like right-wing government might come in power that could labor market highly skilled expats, new competitors like Nikken, etc.? So any views on that?
I'll pick that one up. The primary on ASML. So, see, the political changes in the Dutch political changes aren't something that's that meaningful. So, two reasons there. So, first, a lot of the expat talent that ASML attracts actually sits in their US facilities, not in their Dutch ones. The Dutch talent is much more European than the talent they have in the US. So that worry is anyway sort of low for them, and they have the ability to manage it if a problem is there. Now, and the other sort of the other part of the worry there isn't so much about say competition or from say Nikon, Canon. That's not really the worry. The worry there, and that's probably well beyond 10 years at this point, is actually quantum computing. So that is a fundamentally different form of computing that will have fundamentally different technologies behind it. And when that kind of massive technological shift happens in compute, which we've not really seen it in the last 50 years, but whenever that kind of fundamental technological shift happens is when you really see the entire ecosystem undergoing a change. And a lot of what we see as the big semis manufacturers of today would become less relevant in that world. But yeah, it's like I'll be happy if it happens in my lifetime. But 10 years it's not something that that I worry about.
Sure. Thank you, Jabir. One question. This is a bit long. So how do you factor the 1-year consensus analyst price targets for the high quality companies? For example, NVDA trades at almost 35% discount to 1-year consensus PT. Would this have an impact on inclusion in the portfolio and the weightage? And also in continuation, this is assuming all other fundamental factors stack up like revenue, earnings growth, cash flow, ROCE, market leadership, etc.
So we are not looking into price target actually. So what we are looking into is the forward earnings estimate. So for example, as I was talking about say NVIDIA, we don't have NVIDIA in portfolio, but say StockX, they had an EPS estimate of say $10 2 year out, 1 year back. So 2022, people are estimating that 2024 earnings would be say $10. Now after 1 year, roll forward 1 year, what is the 2 year out earnings estimate? So that is to some extent, if you run regression on a vast set of companies, that gives some indication in terms of the intrinsic value growth or the compounding. Now, so your question was the analyst price target, right? Yeah, so analyst price target, we do not have any impact on that. When you are constructing the portfolio, what do you call something we do is scoring every business, and that in business we assign certain growth rate that for next 5 or 10 years, this is the rate that the company can grow. So that is based on our internal estimate. So our position sizing is actually dependent on that. We do not actually use the consensus for our position sizing by any way. Then the second thing was ROC. What is the question?
Earnings growth, yeah. So considering all fundamental, so this is not a second question. This is basically considering the first question, but considering all the other factors, they go up like revenue, earnings, free cash flow, ROCE, market leadership, etc. So you kind of answered it.
Right. Yeah. So it is part of our business evaluation basically when you're looking at any companies.
Yeah, absolutely. Sure. One interesting question. So obviously we all know Charlie Munger passed away recently, and he was one of the biggest hands in Berkshire. So how do we really look at it now? Because since he passed away, how do you see this share to go ahead?
Yeah, actually Berkshire is one of our largest position. In fact, the largest position that we have. You are still evaluating it, to be very honest. We definitely had concerns given the age of, say, Charlie Munger or Warren Buffett, 90s, 92, I think Buffett is now 92. Again, we're evaluating it, we'll see what to do with it. But at this point of time, I think the underlying businesses are running, as they have been running historically. So there is no change in that. Remember, it is a holding company. But again, to some extent, the way is that the capital allocation plays a big role. And given the passing of Charlie Munger, definitely that is going to be impacted. So we are still evaluating what we do with the stock. But as of now, we have not decided anything.
Okay, sure. So we don't have any more questions. Anything else, Jabir, Arindam?
No, I mean, it's been an interesting year. Looking forward to a few more of those. So yeah, thanks for people who trusted on us. Anything,
just one more question, Arindam, to just pick before let's take this one more question. Yeah. So do you have this gentleman asked that, do you have access NVDA, for example, looking ahead in view of the competition from the big tech, that is AMD and INTC? Would it qualify for your portfolio given that the AI is valued at 400 billion over the next 4 years?
Yeah,
Jabir.
So, see, we do worry about the threat from particularly the big tech companies, to a lesser degree AMD, for NVIDIA, and that's one of the reasons we don't own it. We don't really have firm, high conviction view to tell you that, oh, there'll be X points of share loss over the next 5 years. But we do see a reasonable risk of market share loss. There's also the tech world is somewhat hype prone. We've seen these TAM numbers go from virtually nothing to 400 billion in a year. If you sort of think back to other hype cycles in tech, these numbers, these estimates tend to be tough to pin down when there's as much excitement as there is in AI today. So we're not necessarily focusing on what number different people are putting out for the AI TAM for the next couple of years, but more if you're not confident of market share being sustained, then trying to pin down TAM becomes less important. If you went purely top down, which as a matter of habit we don't do, if you had gone purely top down, we would have bought Nvidia. But since we try and go much more bottom up, and we couldn't underwrite the market share, is why we ended up not owning it.
So it was a conscious call of not owning it.
Yes.
Sure. All right, so we are done with the questions. So thank you, Arindam, Jaybir, and thank you everyone for joining the webinar. Please write to us for any queries and we'll be happy to answer them. Thank you, everyone. Have a good evening.
Thank you.